As I mentioned 2 weeks ago, we saw a very sharp correction in the REIT market. For those that are unfamiliar with the REIT market, those are real estate companies that own assets that are publicly traded on the New York Stock Exchange. REIT stands for Real Estate Investment Trust. Remember earlier that I told you that the S&P 500 fell by 20% in only 21 days. The REIT market fell pretty dramatically too, but in 21 days, it fell by 45%. So taking some cues from that analysis, what it says is that people expected a very sharp correction in real estate values, and they were able to quickly price those in the public market, and it's going to take a little bit longer time for that to flow through in the private market where we tend to operate. The good news is that since that dramatic decline by 45% in 21 days, the REIT market has snapped back and has found a rhythm for the past 10 to 15 trading sessions, hovering around a 30% decline since the peak values established in late February. Year to date, the REIT market is actually still positive, which shows you how strong the REIT market performed in January and February. On an asset-specific basis, technology REITs look really good, and so do industrial and self-storage REITs. What do I mean by technology REITs? I mean REITs that own cell phone towers. That's not really something that we deal with very often. But we do work with companies that own data centers. And given all the increase in e-commerce and the demand for bandwidth created by meetings like this, which are increasingly taking place online, technology REITs have performed very well and are actually more highly valued than they were at the end of 2019. No other industry sector is more highly valued now than it was at the end of the year, but you can clearly see that some are favored and some are not. Industrial REITs are very much in favor. Yes, they've experienced a small decline in valuations, but they're still priced at a premium relative to the value of the industrial assets that they have on their balance sheet. Why is industrial in favor? Because of the increased adoption of e-commerce, which we'll talk about in a few minutes. Some of the have-nots are definitely the retail market, and now you know why. The sharp contraction in the services industry, as measured by the Bureau of Economic Analysis when they provided our GDP numbers this morning, shows you the extent of the pain that could be coming in the retail market. We've all heard stories about tenants not paying rent or asking landlords for a deferral or just forgiveness of rent. The total amount of pain that we're going to see in the retail market is not something that we can quantify at this time. But what we can see is that certain types of retail may be better off than others. Unanchored retail centers, which are typically providing more essential type services, look to be performing better than the malls from a valuation standpoint. It's very rare that you go into a mall to go grocery shopping. It's much more common to go to a strip retail center, an unanchored retail center, for some of the more essential categories.